So
Do you guys want anything to drink? I don't think we offered wine, whiskey,
uh,
coffee.
we might need some. I want some water. I'm good on water. No, I'm good with water right now.
Okay, you guys are.
Thank you.
So green room conversations. So I always think the behind the scenes of the founders' lives are interesting. So you're driving from Houston?
No, I live here in Austin.
Okay, I thought you guys were on the road or,
We were last night in Houston,
Okay.
but we live here.
okay,
Yeah,
cool.
This
Did
is
you have
our-
business there or just kind of
We,
a little bit of both?
we were a finalist for EY Entrepreneur of the Year,
Oh,
but, we didn't win. So,
I'm sorry.
no, it was totally.
Who won?
Whoever won is not important.
The people that won seemed to have a connection to EY,
Oh.
maybe they do their tax and audit,
Always how it
or,
is.
you know. The one guy I thought definitely should not have won was an older guy who's part of a company that's been around for 100 years.
Oh,
He
really?
worked for them for 30 years and now he's the CEO. And I'm like, how are you it's an oil and gas. I'm like, how are you an entrepreneur? You started working in an oil and gas company and that's been established for 70 years.
How did that even qualify?
I think EY does their tax and audit, and so. It's probably helped.
Did you have to apply for that or were you nominated?
Yeah, I guess there were 30 people that made it to the finalist phase.
Okay,
It was fine, you know,
okay,
I would,
30s, that's quite a few.
it's a lot, yeah.
Okay.
Oh, yeah, we live here. Andy's my husband. I don't know where he ran away, but we started in kind, like in 2016.
Awesome. Armando, when did you get started?
I started Hang Tight about almost a year and a half ago, last spring. Feels like 5 years have flown by, but we've been moving pretty quickly. This is my second time working on a startup. I worked on a startup before this, so it was a little bit like deja vu, like a lot of the same issues that you see at the very beginning, but very, very exciting to see so much happening, especially at this point in time when you have the recession, you have a lot of funding drying up, you have a lot of like startups struggling. It's like it's a very interesting time. I think it's a great time.
Yeah.
To be a founder.
Yeah.
So terrible time, right?
It's an opportunistic moment.
Yeah.
What was your inspiration for starting it?
Yeah, so two parts to that. The idea itself, I've had since I was at university at UT. I graduated in 2014, so it's been quite a while. I just couldn't get to doing a startup because I had student debt. I had to get a job, do the real world. But before I jumped into this, the company that I helped found, it had reached like Series B level. It'd gone from 5 people to like 200 people. I was in what we would call like a pretty steady job, and I wanted to change. I wanted a new challenge, something really exciting. And I could just feel that like deep intuitive feeling like you got to move on, you got to do something new, something fresh. And I felt that calling.
Okay.
So yeah.
Okay. Cool. We had someone who dropped. He came and went. What was your inspiration for starting, Corey?
I mean, growing up gay, like I always saw a lot of like inaccess to our liberties. And I think it made me want to start like a legal tech company. Not a lawyer, never worked at a law firm. So I wanted to build something that like had meaning. Hi, welcome.
Hi, how are you?
Hi, welcome. Come on in, guys.
Thanks.
Yeah, wanted to build something that had meaning. We tried selling to law firms for like a full year. It was a total flop. And ultimately lawyers are just not going to change the way that they bill by the hour. Like they don't want to sell products. They don't want to distribute. They want to crack open Microsoft Word and make manual edits to Word documents. So finally we, after almost dying, we found traction running a kind of a B2B2C distribution play through banks and credit unions. And that was really like water to a burn. We're almost 2 million in ARR. Like out of nowhere, it really turned completely around. So founded with a desire to change the delivery of legal services. Tried to do it with lawyers, failed. Now we're running it with like financial providers, and we're hiring the lawyers to go after the market we knew was there that we were trying to get them to go after in the first place. So
That's really
kind of
cool.
the full. Yeah,
That's great. Well, as people start to stream in here, I love to get some background on why people are here and what they're hoping to get out of the session. So we can also start with some introductions for those that are here. So we got a couple people in person. Do you guys want to quickly introduce yourselves and say what you're and where your friend was?
Sure,
What
yeah,
you hope to
so
get out
that
of
was,
that.
so Maxwell Kennedy, my co-founder, just walked out, but my name is Christian Garcia, founder and CEO of Development Incorporated. We're here to just learn a little bit more about fundraising, so that was kind of the idea of the session, and it's something
Cool.
we're actively exploring as well. We're actually just down south in San Antonio.
Haven't we met before?
Yes, we did, via Zoom.
Yeah, did you do the office hours through Start Out? Is that what we met
did,
through?
so we're in the growth lab, and I think that's one of the ways.
Oh, great.
Yeah, super.
So
Okay.
excited to be here. And
What stage are you guys?
for funding?
Yeah.
So right now we're bootstrapping. So we haven't taken on any funding at seed or pre-seed or, series A at any point. So we're just kind of exploring what those options might look like, what our funding options might look like. And, right now we're focused on continuing to grow revenue. We think we have a viable path, but if you want to be a market leader in the industry, it usually, requires you to move a little faster. So we're kind of exploring our options.
Got that. Great. And Alfred, you are virtual. You don't need to, but would you like to introduce yourself? You feel free to come on camera and come on mic. Nice to see you.
Good to see you too. I came to the last meetup with my colleague Kat. I was previously on the board for Start Out a couple of years ago. Glad to be back involved with you guys and to join your meetings, even though this one's virtual for me. I'm based in San Antonio. I run my own business called Deck Savvy, where the specialty is pitching, storytelling, and presentations. I'm also an operating partner at Active Capital, a venture firm based in San Antonio, where we specialize in investing in B2B SaaS model startups. And happy to be here and happy to share some insight if I can, and also just be part of the audience as well.
That's great. All right. Thanks, guys, for joining, and maybe some more people will trickle in. As far as the format is concerned, I think what we're going to do is start the first 30 minutes and maybe 45 minutes with content from our panelists. And then if there's time and people are interested, we'll do some workshop breakouts. Maybe for the people who are virtual, we'll have a couple people do that. And for the people that are in person, and really workshop your funding challenges and funding opportunities so we can talk and make it productive. Cool. So let's start with, and welcome, Ken. Would you like to introduce yourself and also share what you're hoping to get out of this session?
Sure. My name's Ken Colangelo. This is sort of my second act in life. I was previously an economist, macroeconomist. I have founded a social network for TV fans that takes advantage of the transition to streaming, where it's harder and harder to find other people that watch the same shows, let alone at the same pace. And so we are public on both the Android and Apple Store, and are now at the phase where we are reaching out to VCs, and I suppose our last round of angel investors. We did a friends and family round earlier this year. And I'm hoping to get out of the session just more information around the fundraising journey. Like, we have a number of different strategies going, but thank you so much for having us today.
Great. Well, it sounds like we've got some early stage founders, so maybe we can kind of tailor our conversation to the getting started from bootstrapped and decisions around whether or not you choose to fundraise or not. Let's start with maybe 60-second elevator pitches. What is your company? What stage are you at in terms of fundraising? And then we can go for there. So Johan, please.
Thanks for having me. My name's Johan. I'm CEO, one of the founders here at InKind. We're actually in the InKind office here in Austin. We finance restaurants in a kind of a really strange way. We started the company in 2016. We actually started a previous version of it, I think, in 2014. So we're probably more like a Series B company. we've raised in the last 12 months 45 million in equity and 140 million in debt. I think for this discussion, probably, I also like, I'm an early investor in Uber and Twilio and SendGrid and LP and probably 5 or 6 venture funds. So happy to kind of go through sort of my, as an angel investor or as an investor, that side. When we started the business, we did it really bootstrapped. You know, the idea was to raise as little capital as possible. And then when we hit a point where we really thought we needed to grow and own the market, we started raising capital. So I think be super excited to talk to you about that, the journey there.
Yeah, thank you.
Cool.
Cool. Armando Carvajal, co-founder and CEO at Hang Tight. I've been working on this company for about almost a year and a half. What we do is we do AI-powered social hangouts for real-world interaction. We're building a mobile app that makes it seamless, efficient, and effective to figure out with whom you want to hang out, what to do, when to do it, where to go. And it's all backed by very strong machine learning models. We're currently pre-seed, so we're also fully bootstrapped right now. We have raised very, very small amounts from some friends and family, but we are at that point where we absolutely have to start raising for our next stage of growth. There's about 18 people involved with the company in some capacity, advisors, engineers, product, design, etc. I also have, from my previous startup experience, mentoring and advising founders at the pre-seed, seed, and Series A stage, all the way from like strategy to like co-founders to conflict to all the issues that surround fundraising and working with investors. So I do have that perspective as well.
Corey.
Super. Yeah, my name's Corey, CEO at Legal Karma. Started it about 3 years ago. We're a seed stage company, just raised our 2 million fund. So we go into large banks and credit unions and we help them sell wills and trusts to their members. So kind of building a world where you go to your bank to get your legal needs met, not a law firm or like an online form company. It's like a very natural fit with really low CACs for the banks. Ultimately, they're our customer. So it's not a rev share play. They pay us like a large platform fee and then they win all the revenue. So it's like a buy this, make more money play. Yeah, I mean, I've failed, I've won, you know, we had a total fail go to market. So I know what that's like. I know what it's like to turn the ship around and survive afterwards. You know, we started raising in the glory days of 21 and then raised again in the current climate. So born in COVID and have seen, you know, a few different startup worlds in just a very short amount of time. So yeah, would love to make this about the participants and happy to, you know, answer any questions or yeah.
Great. And I think what will be helpful to hear from each of you is maybe your last point of raising and maybe your next point of raising if you're thinking of doing that. And then also to understand how has this year been a little different in the market for you and how has that changed the way in which you've thought about fundraising? So Johan, you want to start?
Yeah, I mean, I think in a lot of ways, this is the hardest time to be raising money, you know, for a lot of reasons. But a lot of it is that, Andy and I were at a investor day meeting for our biggest investors, the hedge fund, and so it's a $13 billion fund, and then they had their investors, CIOs of huge institutions there, and they were talking about, you know, how institutions are allocating capital because usually, you know, Texas teachers or, you know, whatever, they have $100 billion, make that number up, and they say, okay, we're going to put a certain amount into venture and a certain amount into real estate and a certain amount into public markets. And the issue is that the allocation of venture investors have not marked down their holdings. So now all of these big pensions are over allocated in venture. So now as venture funds are trying to raise more money, their investors are like, no, we already have too much of our money in venture. So they're unable to raise money. And so since the funds aren't able to raise money, the companies aren't able to raise money because the funds aren't investing.
Yeah, that's insightful.
Yeah, it was super interesting to hear. And so I think like Yeah, so that's a lot of why it's so hard. So we're raising money right now. We're doing a $25 million round. Thankfully, we have 23 million committed or funded already, but it's taken us a lot longer than it normally would. And I think we had to look at non-venture investors. Because people who don't have like certain allocations that they have to make, or maybe don't have LPs. So we've done a lot from family offices, high net worth individuals, right? Recently, that's been easier for us.
Okay. Yeah, I definitely want to come back to the family office discussion because I feel like that somehow gets left out of the mix and they're harder to find. And JP Morgan Chase has recently launched something called the Connect portal, which is, startup has a relationship there, and they're looking to level the playing field for founders to be able to identify who are these people who have these family offices. Armando, where are you at in your fundraising journey, and how has 2023 kind of come into your mix?
Yeah, definitely. So I did mention we've been bootstrapped by and large up until this point. We have taken some investment from friends and family, very small round, but we are at that point where we do have to raise. We're going after 2.5, and that's direct advice from our advisors, from a lot of the VCs that we talked to for where we want to go. I think this year is different in the sense that VCs are still having a lot of conversations, but the specifics that they want to see are rapidly very much leaning towards traction. Whereas from my perspective at my other company, a year or 2 years ago, ideas were being funded. Right? Just a pitch deck, an idea, just throwing money at them. But now it's like, okay, well, it's a great idea. Let's talk when you have a product. Okay. A couple of months later, okay, we have a product. It's a great product.
Yeah.
Do you have users, right? So the bar keeps moving higher and higher for the earliest stages is what we keep seeing.
Yeah. Corey, how about you?
Well, I was, one of those companies that raised on an idea and no software back in 2021. And it was a bad idea. Like ultimately that go-to-market motion failed. And then, almost died on a good idea in 2023 that could have actually turned revenue. But it's just we got super late stage with multiple VCs and then just kept getting rejections. We walked right up to the line. Honestly, had we not had somebody who just took a really special interest in us and championed us really hard to multiple VCs, I don't think we would have survived. I see a lot of my friends closing their doors, and it almost happened to me. Really close. In fact, this would have been about the time we would have been closing the doors. So we got really lucky. It's hard.
Yeah, something that you said really stuck out to me, which is that you found your champion. And I think, founders not necessarily goal is to raise money. They're found that you're solving a problem, you're doing something for a market. But until you do find that one champion who will, essentially socialize and make credible what you're doing to others, it does feel like there's a conflict of interest somehow because the founder is biased. From our perspective, so our fundraising journey been around since 2012, right? So long time. And we were pre-revenue for a couple of years. So we bootstrapped till 2015. Our first fundraising was from a client, right? Paying us a check. And that's our bootstrapped fundraising. Then around 2018, we took some seed funding, got about $1 million. Wasn't really that much money, but it got us a couple more years of growth traction. And then in 2021, we had enough traction, back to your point about traction, to raise our A round, which again, wasn't a lot of money, about $5.5 million. So we'd taken 6.5, and we just closed a top-up round like today for another $1 million, which goes up to $2 million. So I think every single company has their own journey about how they go to market and whether they fundraise or whether they don't. But I think what's important is that you just focus on your business, and the fundraising will be much, much easier if you have a strong business, whatever that is, like traction, users, profitability, you name it. And now in 2023, I would say that's more important than ever. VCs are looking to fund businesses more so than ideas. let's turn it to some of the, yeah, please, you have a question.
I'm sorry, can you remind me your names?
Armando.
Armando, so you keep talking about a point, like an inflection point of your journey of understanding like when is the right time to raise.
Mhm.
So are there metrics around that, or how are you exactly deciding that point?
It's a great question. I think once the rubber really meets the road in terms of go-to-market, in terms of like costs, engineers, products, all of that, there comes a point where we can't rely on our savings to finance that, and we really need to have that growth mindset. Like if this scales rapidly over the next year, it's going to cost this much. And if we want to reach these top 10 markets across North America, we need this much capital. Otherwise, we go the way of like, we won't be around if we don't make those drastic jumps forward.
So really kind of like your bottlenecks are almost in a sense trying to push you towards the funding environment. Okay.
Essentially.
Yeah, I think I would probably say like, you certainly have to fundraise if you're running out of money, right? Like that's when you die. So like, if I wouldn't necessarily like in this funding and raising environment, I wouldn't really be raising as much to take on as many investments, like, risk, right? Or maybe new markets, which, when equity is cheap in 2021, you want to raise as much as you can and place all those bets, right? In today's world, because money is more expensive, fundraising takes a lot of time. I think the question, around focus on fundraising will be 80% of your world, in your brain for a long period of time, if that's what you decide to do. So if you can just focus on the business and not fundraise, then I think that's a better option, unless there's an absolute need for capital. And that's either you're going to run out of money or there's some opportunity you just really, really, really have to go after, or know it's like perfect timing to go after, and then you go and raise to go after that option.
So like you could dominate the market.
Dominate the market, I think, is a hard one, like, because that's a depending on the market and the size, that could be $10 billion in capital that you need to raise over the next 10 years to do that.
Smaller,
Right. If it's a smaller market, then you're probably gonna have a hard time raising capital, right? Because an investor wants to invest in something that's a big market with a
return.
100x return.
Let's talk about the smart entrepreneur. So the smart entrepreneur is someone who fundraises to grow their company to be successful and make as big of an impact as you possibly can, while also protecting yourself, right? And so what I'd love to hear is what went into your personal, like between personal and professional decisions around equity or debt, like how much I'm going to raise, what's my valuation, right? Because sometimes how much you're going to get diluted affects how much you might raise or whether you might do debt or equity. And I'd love to hear that intersection of personal and professional from your perspectives. So Corey, you want to go first?
Yeah, I mean, I guess I was just thinking, I feel like it just kind of happened to me. Like, I don't know that it was like intentional. I think in 2021, I was really naive. I was a new entrepreneur. I just started it, had never been and never really seen myself as that or was familiar with the world. And I raised like 500K in like a few months, just with an idea and a pitch deck, like just hit this. And I was like, wow, this is easy. Like, I'll just stop here and then pick it up later whenever I want, not really appreciating like what was happening in the market at the time. Fast forward the clock a year later, Legal Karma is trending toward a fail. And then I go out to raise again, really different environments. And I feel like we had to take what we can get. And I put the company in that situation. And so I don't know if I was the smart entrepreneur is the truth of it. I think I put myself in a situation where it happened to me, and I don't think I really had a say in the matter.
Well, I would call you the resourceful entrepreneur.
I'm the still in business entrepreneur, which is the best kind of entrepreneur to be in 2023. So half of staying, half of being an entrepreneur is staying an entrepreneur, which is its own journey. So I don't know how smart it was, but hindsight's 2020, and there's times where you just take what you can get, and you're put in a situation, and then it doesn't matter what you feel about it. Like the investors knew the situation we were in, and the situation I had let the company be put in, and they took advantage of it. And I didn't have. Checks out. Like, I mean, I understand that's the incentive. Like, there's no, I made the wrong call.
Mm,
you know, in that way.
mm.
Yeah.
So just to sort of level set in this conversation, if you raise $1 million and your company is worth $10 million, the investors will own 10%. We're aware of that. However, if you raise $1 million, and that's equity, if you raise $1 million in debt, you still own 100% of your company. So have you considered, Armando, debt versus equity and sort of what has gone into that decision or strategy?
Absolutely. I think like non-dilutive capital is always the best capital that you can get, especially if it comes in the form of like a grant from the government. Traditional debt, while very attractive, is very expensive right now. And I think I've had experiences, not personal, but I know of founders, I know of companies that have gone under very fast because they took out debt during the good times. They weren't smart entrepreneurs during those good times. They weren't resourceful. And then 2022, 2023 swung in, and now they're out of business because the creditors came calling in. I think it makes a lot of sense, and it's there for a reason. It's a resource, it's a tool to drive growth in favor of the owners, in favor of the shareholders in a non-dilutive way. But you have to have a very clear plan as to mechanics of it, especially if you have revenue. So like in our case, for traditional like B2C social tech startup, it would be very risky to say, oh, we're going to take out debt, right? If you can even find a creditor that's willing to underwrite that. We have to think like forward faster because of what you said, right? Like times have changed very fast. Investors want to see revenue. And most B2C startups won't even talk about revenue until like year 2 or 3, right? They'll hope they'll get acquired by then. We have to figure out how to make money by now, like this year. And if we can get to that point where we are consistently generating sustainable revenue, then debt can become a part of the conversation because there are mechanisms. Rev share agreements, there's different ways to.
So what I'm hearing you say is that it's a tool to augment, but not necessarily something to rely on because it does increase the risk of whatever might happen in a bad way.
Well, and I think perhaps the underlying question is also, if you want to build a company that will conquer markets, that's going to maybe change the world, like you're probably going to have to raise a lot of capital. And dilution will always be a part of the game. I think I've met a lot of founders who are very averse to giving up equity in the company. We acquired one of our competitors earlier this year, and they had a lot of term sheets, and they didn't take them because the CEO didn't want to give up equity. Right. And it's one of those situations where like, we were acquiring you because of the decisions you made, and now this is a good deal for us. I think you have to balance the timing and believe that you bring in the right partners for growth in the beginning, give them their share of it because they're on your side of the table when they join you, and then finance future growth with debt where it makes sense.
Johan, how do you think about, I mean, I really admire your model and what you've been able to do, and it's just to me so creative and truly innovative. How would you say you thought about this? It sounds like you had a plan and you did this intentionally, right? And you talk about that maybe for other founders who might not be familiar with alternative financing models.
Yeah, I think I definitely don't think we had a plan and we're super smart and figured it out. I think we stumbled around in the dark for 7 years, and didn't run out of money, so we didn't die. So so we were able to continue. And I think that's to me the most important thing is like, whatever our plan is probably not going to execute in the way that we think it will. So I would never be afraid of dilution. I would overraise as much as you can. It just gives you more runway. Ultimately for us, early on, we raised from some venture investors, and which was great. Like, and they were willing to take venture risk, and investing in our company. And then last year or 2 years ago, I was actually able to buy out the venture investors. So they had a great return, they were really happy. But I could kind of graduate to other types of capital that won't take as much risk, but are not looking for as high a return either. Right. And I think ultimately the founders, like, the reason you shouldn't be afraid of dilution is in the long run, you can figure out you're in it for the long run. Your investors have some like life cycle that they have to be out of your, out of investing in you. They're not trying to hold stock forever in your company, right? So you can kind of take advantage of that. what we discovered along the way was that there's a lot of capital out there that's not venture. So what we did, our business is very capital intensive. So we finance restaurants, so we need money to give it to the restaurants. I don't want to raise that as equity, and because that's super dilutive, right? If I have to go raise $150 million to give to restaurants, and I'm doing it as raising part of in kind, I'd have to sell like 90% of in kind, right, to raise that money. So what we did was we created something called a warehouse facility, where basically we buy, call it inventory in restaurants. We buy credit, food and beverage credit. The warehouse is actually not in kind, it's a subsidiary of in kind that buys the warehouse, that buys the credit. We put in 10% equity, so it's an $88 million facility. I put in $8 million off of our balance sheet and borrowed $80 million. So to your point, lenders aren't going to lend to a startup unless you have, they're going to lend against profits. And most of our companies don't have enough profits to borrow anything meaningful, right? We might get 2 turns profit or 3 turns, which means if you're doing $100,000 in profit a year, you might be able to borrow $200,000 or $300,000, which probably isn't going to move the needle. But what this facility does is it basically says all the inventory. So it could be contracts for companies. It could be, there's all kinds of ways that you can kind of create an asset. That's owned by this warehouse, and the lender is lending against that. So even if your company goes out of business, the lender then owns the contracts or the, in our case, food and beverage inventory or whatever, right? And so we're able to raise a lot of money, and it's non-dilutive to us. And so I'm happy to talk in a lot more detail. It's something that I had really just everyone thought about. We happen to have a board member who's like amazing human being. He used to run billions and billions of dollars in private credit markets. So he took us to 27 of the biggest institutional investors and like pitched us. We ended up with 3 term sheets, you know.
Wow.
These are massive funds. I had no idea about any of this until meeting him. So that you know, just dollars that like at a certain size, it makes sense. Like these, we couldn't have borrowed $5 million. Like the institutional investors, like the smallest check we can write is $50 million. You have to get a certain size to unlock those things. And right now, I think debt would be really hard, traditional debt. Venture is probably the best choice for like a seed, pre-seed kind of business. But, you know, right now, I would say like raising money from customers is always good, you know, because they like in this, you know, we work with a lot of point of sale companies for restaurant groups, people like that who may have cash right now, and you know, they're more willing to invest in us, and we can help them when, you know, with their technology and things like that. So that I would look at, right now it's so hard to raise money. I would look at like anybody who has money that wants to support your business, right? Like and do a deal with that.
So when you say that, you know, like, do you mean by them voting on your product with their dollars paying for, or you actually mean like actually reaching out to your customers and, you know, trying to facilitate some kind of round or something like that?
I mean, if you could just sell your product and earn enough cash flow to build your business that way, that is the way that people used to build businesses for a long time. That's the absolute best way to build a business. You know, I think that's hard, like in a lot of cases. So I would probably do a combination of both. You know, you do a commercial deal with the customer and you say, hey, as part of this commercial deal, if you want to also invest in my business, because you're helping me grow, right? Because you're giving me a contract that's worth money to me. So you can take advantage of the valuation increase that you're creating by investing in the business. The only problem is you don't want to be beholden to that customer, right? And you don't want other customers to not work with you because they're like, my competitor owns part of that company. I'm not going to give them $1, right? Because that's going to go to my competitor.
It's a deal with the devil sometimes. Let's get practical and tactical. So now that you have your master's in entrepreneurship, right? You've created a company, you've done some fundraising. What would you say the skill of fundraising is? What is it that you have learned that you'd like others to know about? How do you do it? Literally, how do you do it? If you were just writing on a napkin, like the 5 steps to fundraising, like what are those 3 steps or 5 steps that you think are most critical? I'm gonna start on this one, then I'm gonna let you guys rip. So from my perspective, you gotta know your numbers and know how to speak that language, because it's not just about the narrative and the story and the product market fit and all of that stuff. And for me, I'm a filmmaker. I'm an educator, right? I'm a teacher. I'm not a business person by trade. So that lift was really hard for me at the beginning, to be able to speak numbers and speak traction. That was certainly one thing for me. Two was really just understanding that it is a process, and you will probably have to pitch that same investor 5 or 6 or 7 times. And some people think it's a one and done, and then you've raised all your money. But it's definitely a long game. And I think some people just don't realize that this last round, even though we've raised before, took us 8 months, right? We're pitching our existing investors, right? So it never really ends. And then the third piece, at least for me, I would say, is like becoming aware of all the different types of investment and models. That's a book in and of itself, right? That is an ongoing study that I'm learning from even today. So Corey, what are your top 3 tips? Like if you had to tell somebody, here's how to do it, how do you do it?
Yeah, I mean, it's one of those conversations where people can build a whole career around being a good fundraiser. I mean, like the greatest hits for me are probably like, find relevant investors, like find it, like a lot of people just go and pitch like the big world. Like there are people out there that are serving your ICP and want to get to know businesses that
Ideal
serve
customer profile.
Yeah, that serve your ideal customer profile, and they're looking to invest in companies, and they already get your industry. They already have what's the word, conviction in your industry and the problems that your industry faces. And so you might get a lot of rejections. But if you are getting rejections from people that are in your industry, that's a really good flag, because you want to take their feedback to heart. I think another one is I think like an unappreciated skill of entrepreneurs, or like determination. Like you're gonna get super late stage with so many funds, and then they're gonna say no, like at the very end, like at the 1 yard line, as sports people say. I think that means you're close. I think it means you're close to making a goal. But your ability, like there's people who call it grit, which I think is just doing the same thing over and over again. But like determination, like there's a lot of founders that I think just lose and then give up. Like there's never a good reason to keep going. Like being a founder sucks. It's not cool. Fundraising sucks. It's not fun. Like, and you're going to fail, and your ability to like hear no 1 million times, but then still say, no, I'm going to do this and then do it again. I think that's a really special skill that most people don't have that go down that road. And those are the people that make it. And there's no good reason to keep going ever. But the people that do are the people that figure it out. Like your ability to like stumble in the dark for 7 years and then come out on the other side. Like most people won't stumble in the dark for 7 years. So let's see, relevant investors, determination. I guess it's like it's an opportunity, not a request. Like people always put like what's your ask at the end? Like you shouldn't be pitching an ask. You should be pitching an opportunity. Like their ability to make more money is the only reason they're going to invest. And so always frame it as like, this is your chance to get in on this, and know what you want from them and why them.
Armando, top 3.
Yeah, I think the first would be timing. I think start early. I think I've seen a lot of founders who wait until they're out of money to go banging on the doors and say, I need money. The reality is it's a highly relational space. It's all about who know, but it's all about the relationships. And I think to Corey's point, they're looking for an opportunity, and venture investing is a long-term game, right? It's not hedge funds where you're in and out in half a second. They're in it for 7 to 10 years. They have to like you. They have to trust you. They're going to be there on your side of the table, and it takes time to build that relationship. I've never been on a date where, I'm ready to propose on the first date. It's the same way with an investor. You have to like get to know them. You have to have drinks. You have to hear the rejection. You have to get their advice. And I think like the no's is something that you really just have to roll with. You're going to hear so many of them. I've had the chance to go to my 5th and 6th meeting with the big funds in Silicon Valley, and it sounds like this next meeting is going to be a yes. And then they're like, oh no, we'll come back next time, right? And it's like, I'll be back next time. You have to have that conviction and mindset. People is super important. funds aren't necessarily backing ideas. They want to back something big that's going to make them a lot of money, but it's also about the people behind it, right? They want to know what makes this idea worth our time, our allocation of capital for the next 7 to 10 years. Will it give us an outsized return? But more importantly, why you? And like, what's so special about you? And it doesn't have to be, oh, I went to Harvard, right? It's like, what is so unique about you that will bring everyone together to turn this into a big success for us?
Yeah, I think to what Corey said too, what they're looking for is, why will you not quit?
Right.
I mean, that's the why you thing more than anything. It's like, what do you have? Why is your skin in the game here?
And that is great.
Yeah.
Mhm.
Johan, what would you say your top 3 fundraising tips?
I think you guys like pretty much nailed all of them. So maybe I'll rephrase like that. I'm not adding any more value. I think you're gonna hear no a lot, and it's not even I hear no a lot, you know, and then my reaction is like, well, clearly you're dumb because like I have a great business, you know, and you don't want to invest in it, and you have to have that mindset, right? Because otherwise it just wears you down,
Yeah,
right? And
So I'm Johan's husband and co-founder, so I will add one that he's very good at, and it annoys me because I'm a bit of an introvert, but showing up. So if there's ever an opportunity to meet someone, or someone you know is like, oh, I want to introduce you to my friend, Johan says yes every single time. And recently, so somebody who invested in the round that we're doing right now, Johan met them because somebody asked him to go to Vegas, and I really didn't want him to go because of Vegas. But we had 101 things going on. He's like, no, it's important I go. He got there. Somebody else who was at the dinner was like, oh, you should meet my friend. And that person is the one who invested. And so it's sort of, you never know who you're going to meet or who you're going to be introduced to. So even if you're tired and you kind of just want to go to bed, it's like you have to make yourself go out and, you know, meet those people, because somewhere along the line, someone's going to introduce you. So.
Yeah,
Yeah.
I think that's a good one.
That's true. And I think that's going to be related then to what I think the mistake that a lot of people make when they're raising money is they just start pitching. They just start talking about their business. And really, you should ask a lot of questions about the investor. Like, why are they investing? What are they looking for? What's the size that they're looking to invest in, you know? Well, and then once you know all of those things, any questions they ask you about your business, you know how to frame in a way that's like going to make sense for them.
Yeah.
Right. And in this case, the family office that Andy's talking about that invested, they just wrote a $2.5 million check. They're it's a very famous band. And there's a lot of things that they want to do with us. They own a whiskey, and they want our whiskey, their whiskey, and we have 800 restaurants, right? So there's like, we didn't even talk about investment. The conversation was around, you know, what are they looking to do? And then eventually 3 meetings later, they were like, are you guys raising money? And we're like, yeah, we're a company. We're always raising money. And, you know, and they invested $2.5 million.
That's great.
I think that's
fantastic. Well, time flies. It's been 45 minutes of excellent conversation. I know, right? Can you believe it? We are going to transition to workshopping your fundraising opportunities and challenges. So I'm going to invite Alfred and Ken to stay here. I can bring on one other expert to be a part of that conversation. Would you guys like to do that virtually, or would you prefer to sign off and go about your day? You tell me.
I just have a few questions in the comment section. I mean, it wouldn't take very long, but I could stay on.
Yeah, I'm still
okay.
good for
We can
another
answer
like
those.
30 minutes. So happy to be part of it too.
Okay. Well, how about this? I think you guys make a good pair because you're coming from different perspectives, and then Corey, you and I can stay on with the virtual group, if that works.
Okay, super.
Okay, cool. So do y'all want to pair up with these guys, and then Corey, you can come over here with me?
Sure, absolutely.
Okay, cool. Great. So I think we'll turn this camera off, or that's John, this is your, or Andy, this is yours.
well, anyway, we'll jump in a different room.
Yeah, you could do that.
Yeah,
Is that cool?
Yeah, I'll come join you when we're done. If this is
Yeah.
Okay.
quick.
Okay,
Andy, we're gonna get Houston.
Okay.
great.
Okay.
So guess you can see us here, right?
I'll go with that. I'll take
Where's the, is this the camera? Right.
That's the camera. Can you believe it?
That's
It's
just
like
me
staring at
video.
us.
Yeah,
Yeah,
that's
it's crazy.
You look really familiar.
So can you guys still hear us okay?
Yeah.
Okay.
Yeah.
Well, good. So let's start with your questions. Can safe versus price round proceed?
Well, do you want any water?
I think we'll probably answer that the same way, but if this is a game show and this is Hollywood Squares, what would you do?
I think your investors are gonna tell you what to do.
Okay.
I've never heard of a founder getting to choose that,
Hmm.
and it's, if they're gonna do a price round, it's their incentive to go as low as possible, and you're in a really negative negotiating seat to be trying to raise like a priced round at a seed stage company. Like if you have less than $1 million in ARR and you're trying to get a priced round, they're gonna set the price of your company really cheap, rightfully so.
Yeah.
You don't want that.
Yeah, I
my
would
opinion.
agree. I think that's that. I was say the exact same thing. I think you should definitely do a safe. And I think that's kind of industry standard now because a price round kind of puts you in a compromised position as a founder. You have no clue, like your business could be really much bigger than what some investor says it's worth. So,
Thank you.
cool. Yeah, and then, or using okay, is there safe or blah, 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 or using a fundraiser advisor like Fundin. I've never heard of Fundin and I don't know what a fundraiser advisor might be other than like a regular advisor.
What's a fundraiser advisor? Is that someone that's
Yeah,
gonna like
what's
help
their
you raise-
take? What's their take on it too? That's my question.
Right. So I guess you could sort of pair this with an accelerator question. It's like different accelerators have different terms. Like Y Combinator will take a percentage of the equity if they connect you with warm intros. There are other ones. Fundin doesn't take any equity. They have like a $3,500 a month retainer, and they work with like 200 plus investors that they already have pre-existing relationships with. So like, I know not every accelerator or incubator is sort of like of the same cloth or have the same terms. And so when we keep on talking about it at exec, like, should we consider applying for certain accelerators? Should we consider selling a percentage of our company in order to get a good one? Like, we've gotten really good. Of course, they're like very, yes, please sign up, send us money. But like, we just want to make sure that we're making the right decision because I'm a first time founder and I don't want to not turn over any rocks that are available.
I have a strong perspective on this. So we participated in 2013 in an accelerator by Dream It Ventures, which was in New York, and there were probably other 10 or 12 other companies. At least for me, because I was also a first-time founder, that 3 months was pivotal with regards to how I approached my business. And I did meet a lot of other founders. I met a lot of other investors. I raised no money out of that, but they took 6% of my company. I then bought back 3% of that company, but they gave us $25,000 in 2013. And at that time, that $25,000 was the only thing that kept me going in that business. I would have quit for sure. So I think it's very personal, and I think it's now what I might advise, rather than, I think of an advisor who takes a 0.5% or 1% is okay, or an assistant who can help you at an hourly wage to essentially do all of the outreach to get your meetings on the books. We did that for our A round, and that was very valuable. But I think, be cautious and be careful, know yourself. And it's hard because there's a lot of organizations that are exploitative out there for sure. So how
I joke that if you think you get a lot of spam calls, why not tell people on LinkedIn you're a founder, and just the number of spam like increases quite significantly.
Yeah. I like the perspective that it's a very personal decision. And I think it really is that, because you can talk to, 100 founders that went through Techstars and said it was a waste of time, and 100 founders who went through Techstars and said it changed their trajectory of their company. I don't think, if your end goal is to raise money, if your need is introductions to investors, don't spend money on that. That is absolutely artificial value. Take that money and go buy like Apollo, go buy a sales intelligence tool so you can query your own investor lists
and then email them. I would absolutely not pay for intros. That's complete bullshit. They're selling you bullshit. In my opinion.
Thank you very much. No, that's very helpful.
Yeah, I was going
If
to say
you
also,
need-
if somebody, go ahead, sorry.
Well,
think I
the
cut you off.
the reason to do an accelerator is if you're like a first-time founder and you're like, I don't know what I'm doing. I don't know what a cap table is. I don't know what a restricted stock purchase agreement is. Like, I don't know what to do about this weird, obscure founder thing that's coming up, and I don't have community to help me figure it out. That's a really good reason to join an accelerator. But intro, I've never once heard a founder say, wow, I went through this accelerator and we raised our whole round and it was so good. Like, I mean, those stories are so rare.
Thank you.
Yeah. And
I was going to say the same
thing.
thing, just also as somebody who works with founders myself and who works on the VC side of it, accelerators can be a great springboard for you, especially learning how to actually operate the business as a founder and to wear all those hats. But yeah, don't pay for access only, or network. Founders like to help each other, and it's really just asking for that help and going to these, events and learning how to network, that you get these introductions and these opportunities. That it's more organic, but it's I would still say that that's much more of the time tested and more relevant way to do it than paying for it.
I agree.
Yeah. I also think, well, when we were starting, I didn't really know what startup was, so I wasn't really plugged into, and I also think startup wasn't as mature as it is now. So I think startup is a really phenomenal resource that there's also Out in Tech, and then I think there's now a Angels Slack channel. And most of the time they're pretty accessible. I think showing up to events and building relationships and asking these types of questions is really part of the journey. The programming obviously is erratic and sporadic, so it may or may not serve your exact need, but meeting entrepreneurs who are at your stage, maybe that's not as useful as meeting entrepreneurs who are a little bit more advanced. Like, I just learned a lot from
Johan, same. I was like
so, but I do think getting consistent guidance from advisors is really good. And for me, that was pivotal to my business. So I actually signed on 3 or 4 advisors early on, and I didn't really have anyone in my company at that time. One of them has now been a full-time employee now for 6 years at our company. He was one of the first advisors. One of them's now on our board, like literally board of our company out of 5 people. One of them we've hired as a consultant, and they've all been pretty transformational to our business. Identifying those people is, in my opinion, really critical in the areas that you are not good at, right? I did not consider myself to be a good operations person. I'm more on the kind of sales and, I don't know, product side. And so I brought in a COO who basically show runs the business. And that's a really good yin and yang, but he was just an advisor at the beginning, And the other thing he's really good at is helping to guide the business decisions, because we've been put in positions where we would have absolutely been compromised as a business. And as a founder, you are sometimes compromised with your decision-making, right? You're trying to protect yourself. You're trying to maybe stop people from getting fired or whatever. But you need a group of people who will protect you too, right? And not just be worried about your staff or, this or that. So I don't know. Find people who have your back in addition to the back of your company. That's really important. It's easy to get lost in your own company, actually. Alfred, were you saying something? I think you were on mute.
Oh, I was just agreeing with you.
Oh,
Nothing.
Love that.
Yeah, nothing apart from that, but yeah.
Definitely go ahead.
Alfred, did you have a question?
No. So I'm not, I myself am not raising, but I work with a lot of founders that are raising. So that's really where I think I can impart some of, my own, knowledge or experience in in this discussion. But yeah, it's, you know, I think this all resonates. I agree with what you guys are saying, and a lot of it really is, you know, I think if you just look at the structure also of just VC and how I think VC is changing for the better, but a lot of the kind of age-old stuff that is, as somebody who works in it, but I'm not an investor myself. You know, it can be frustrating to when you realize that a lot of it really is, you know, who you know and that network and learning how to really tap that network when you need to and be strategic about it. But there is a lot more opportunity, I think, on the VC side, where now we do have a lot more of these, you know, specialized funds, these more diverse funds that invest in entrepreneurs from many different, you know, walks of life, many different skill sets, many different backgrounds. So there's a lot of resources out there, and even if you look in the last, you know, 3 to 5 years, it's been pretty groundbreaking, I would say, in my experience. So I think, you know, it's despite what the market looks like right now, I think the future is still very positive, and VC is making some very positive changes and some new trends as well.
For sure. Cool, guys. Well, thanks for joining this this session. If there's anything that I can do, and I think probably speak for Corey too, to be helpful to you guys, you should reach out and let us know.
Absolutely.
Yeah, would love to stay connected. I'll put my email in the chat.
Sure.
I was going to
Ken,
say, like, I was
I
going to
saw
go
that-
back to the invite.
Oh, I didn't mean to cut you off. I'm sorry.
Names are there. No, it's just I just wanted to. I would love to stay in touch, and I mean, I'd love the building on the community. So, thank you for adding the email, and I appreciate everyone's advice.
I saw you had a question too about state programs, and I would just say start at the local level. So like, you may not know that even your local chamber of commerce may have like an innovation program or something. I know that here in San Antonio we have one, and it does provide some grants to startups that choose to stay and build here, as well as access to office space and other resources. So start, you know, hyper local, and then you know, move from there and see also what the state programs are that you may be able to take advantage of.
Thank you.
Awesome. Keep us posted on your journeys.
Will do.
Absolutely. Oh,
Thank
I'll
you,
leave my
guys.
contact info too. Thanks, y'all.
Awesome. Thank
Great.
you.
Y'all take care.
Bye-bye.
Bye.
Bye.